Hey everyone, and welcome to AI Explains ICT. In this video, we're jumping right into some fantastic material from the core content, specifically Month 10, Episode 11. We're going to be focusing on a really powerful daily pattern, the AM trend in index futures. I'd really recommend grabbing a notebook because you are definitely going to want to take some notes on this.
And as always, just a quick heads up before we start. Everything we talk about today is for educational purposes only, so please think of all these concepts and ideas in the context of paper trading.
All right, here's what's on the menu today. We're going to kick things off by defining the AM trend and, getting the timing right. Then we'll dig into what actually causes the move in the first place. After that, we'll get to the secret weapon for confirmation, index SMT. And finally, we'll talk about how to actually trade the signal. So let's dive in. Okay, first things first. We have to know when to look. This whole section is about pinning down the AM trend. And that very specific time window, you need to be glued to your charts.
So what even is the AM trend? Well, you can think of it as the morning swing. It's this super consistent price move that tends to happen pretty much every single day in index futures. It's that reliable directional move that really sets the tone for the first part of the US session.
Now, take a look at this chart. It does a great job of defining our playground. The AM trend kicks off right at the 9:30 a.m. New York Open, and it usually runs its course until about noon. You can literally see the handover here from the London session into the New York AM session. That's our sweet spot. So these are the times you need to burn into your brain. The main session is 9:30 a.m. to noon New York time. But you've got to pay extra close attention to that first hour from 9:30 to 10:30 a.m. Why? Because that's often where the actual high or low for the entire day is going to form. And this trend, it can either be a continuation of what London was doing, or it can totally flip the script and be a massive reversal. So, a trend doesn't just appear out of thin air. There's almost always some kind of catalyst, a specific price pattern or a key level that gets the big players, the institutional order flow, to react. Let's look at a few ways this whole thing gets started. One of the most common catalysts you'll see is a bullish order block. Look at this chart. Right after the 9:30 open, what does price do? It trades right down into that previous down close candle. That area acts like a trampoline, and you can see how price just explodes higher right off that level. Okay, here's another big one, a bullish breaker. What's cool about this example is that the setup was actually created way back in the London session. Price took out some old lows, which formed the breaker. Then, fast forward to the New York AM session, price comes back down, retests that exact level, and boom, it launches the morning trend. It's just a beautiful example of how one session can set the stage for the next. And this one perfectly illustrates a third catalyst, the famous turtle soup. This is your classic stop run. You see price dip just below a really obvious previous low. What's it doing? It's grabbing all the sell stop liquidity that was sitting there, and then it just violently reverses. This fake out move is often what kicks off a really powerful AM trend in the other direction. All right, now we're getting to the absolute heart of this model. We've seen the setups, the catalysts, but how do we confirm that a big move is really about to happen? The answer, my friends, is index SMT divergence. This is your ultimate validation tool. The rules are actually pretty simple, but they're incredibly powerful. For a bullish SMT, you're going to compare the lows across the big indices, the S&P, Dow, and NASDAQ. What are we looking for? We're looking for one of them to fail to make a lower low while the others do. This is a huge sign of accumulation. For a bearish S&P, you just flip it. You compare the highs, and you're looking for one index that can't quite make a new higher high. And here it is, a perfect example of bullish SMT in the wild. Look really closely here. Up top, you see the NASDAQ makes a clear lower low right at the open. But, and this is the whole game, look at the Dow and the S&P on the bottom two charts. What do you see? They both make higher lows. This is what ICT calls a crack in correlation. It is a massive, massive tell that smart money is quietly buying, and the market is very likely about to head higher, even though the NASDAQ looks weak on the surface. So this probably brings up a question, right? Why are we looking for this divergence specifically between 5 a.m. and 9:30 a.m. New York time? What's so special about that window? Well, the logic is all tied to the global market hours. See, around 5 a.m. New York time, all the traders in London and Europe are just getting back from their lunch break. They've still got a few hours left in their day, and they start pouring money into the US markets. It's this huge influx of order flow that creates these little cracks, these divergences, right before the New York Open. Now, this is a really crucial piece of advice from ICT himself on this topic. Don't go looking for something that isn't there. You want divergences that are clear, classic, and just plain obvious. If you have to squint your eyes and tilt your head to see it, it's probably not a high probability setup. Like he says, when it's not obvious, assume it's not there. Okay, we've identified the trend, we've spotted the catalyst, and we've confirmed it with SMT. Now for the really fun part. How do we actually get into a trade with this signal? So there are really two main ways to go about this. First, you can buy strength. That basically means you place a buy stop order just above a recent down close candle. You're trying to hop on the train just as it's leaving the station. The second way is to buy weakness. This is where you actually target the one index that did make the lower low, that's your turtle soup, and you look to buy just below that old low, catching the reversal right at the source. And this quote from ICT just sums up the logic perfectly for that buy weakness entry. It helps take away the fear of buying something that's making a new low. Because when two other major indices are basically saying, nope, we're not going any lower, then the one that does, well, that's just giving you a beautiful turtle soup entry. You can feel a lot more confident stepping in front of that move. All right, I know that was a ton of information, so let's slow down and just boil it all down to the absolute key takeaways you need to remember from all this. Okay, so here's your checklist. The AM trend runs from 9:30 to noon. It gets kicked off by an order block, a breaker, or a turtle soup. Your number one confirmation tool is index SMT divergence, which you're going to look for between 5 a.m. and 9:30 a.m. For a bullish setup, you need to see one index that refuses to make a new lower low. And please remember, only take the signals that are super obvious and clear. And hey, if you found this breakdown useful and you want to see more content just like this, do us a huge favor and hit that like button and subscribe to the channel. It really does help us out a lot. And seriously, if anything was confusing or if you just have any questions at all, drop them in the comments section below. We have a real, live human who reads every single comment and will get back to you. Until next time, I wish you all the best of luck and safe trading.